Hey there and welcome to the channel. In today's video we are going to be going over my highlights from the Berkshire Hathaway Letters to Shareholders written by Warren Buffett himself. And if you haven't read the letter, I would highly recommend you do that. And also, if you are really interested in investing, which I'm guessing you are since you're watching this video, I would recommend going all the way back to 1956 and reading all the letters to shareholders from Warren Buffett. You can really learn a lot from it. So the shareholder letter starts with a beautiful tribute to the great man Charlie Munger, which left us in November, a month short of his 100th birthday. And in the letter, Warren talks about Charlie being the architect of Berkshire Hathaway, and Warren himself being in charge of the construction crew, where Charlie should forever be credited with being the architect of the company. Now, my first highlight from the letter itself is where Warren is talking about the difference of GAAP net income and actual cash from operations, which he has talked about a lot. If you read his old letters, you can see him give an example of the net earnings according to GAAP, were for Berkshire Hathaway. The numbers for 2021 were 90 billion, negative 23 billion for 2022, and 96 billion for 2023. So they're basically going all over the place. But if you look at the operating earnings, you can see that they tell a much different story of a much more stable company, which is the Berkshire Hathaway that we know, where they had 27 billion of operating earnings for 2021, 30 billion for 2022, and 37 billion for 2023. So you can see there's a big difference there if you just take the numbers from GAAP and you believe that those are the true owner earnings of the company. And another timely reminder from Warren, where he talks about that it's very hard to predict who will be the winner and losers in the stock market, and the people that are telling you the answers are either self-delusional or snake oil salesmen, or maybe some kind of mix of the two. But I still find it incredible how many people in the financial world are claiming that they can somehow predict how the markets are gonna rise or fall. My next highlight is where Warren talks about Berkshire having the largest GAAP net worth recorded by any American business, where they have in shareholders' equity $561 billion, where the total GAAP net worth of the rest of the S&P companies was 8.9 trillion in 2022 and is unlikely to exceed about 9.5 trillion in 2023, which means that Berkshire is about 6% of the whole. And Warren talks about it being nearly impossible for the company to double in the next 5 years. And a double in the next 5 years means about 15% CAGR. So shareholders shouldn't expect to get 15% on their money for the next 5 years, which I do agree with. So the investment universe for Berkshire is really small. And Warren talks about here that outside the US there are essentially no candidates that are meaningful option for capital deployment at Berkshire, and they have no possibility of eye-popping performance. And Warren is predicting that Berkshire should do a bit better than the average American corporation. So if the S&P does about 9 to 10% with dividends reinvested, they should be able to do maybe 11-12%, but anything beyond slightly better is wishful thinking. So Warren is always keeping it real for his shareholders and not inflating them with some unrealistic expectations. So that's what we like about him. And the next point that I highlighted was, in my opinion, very interesting, where he says if you believe the American investor is more stable than in the past, think back to September of 2008, where the speed of communication and the wonders of technology, they facilitate an instant worldwide paralysis, and such panics won't happen often, but they will happen. And the stock market today is massively larger than it was when he started to invest. But today's active participants, which are, I think he's talking about the active investors, not the passive investors that are investing in index funds, they are neither more emotionally stable nor better taught than when he was young, and for whatever reasons, the markets now exhibit far more casino-like behavior than they did when he was young. The casino now resides in many homes and daily tempts the occupants. So Warren is saying that just because we have all this information available to us through the internet, it doesn't mean that we are utilizing it. And investors today are no better or even worse than they were back in the day when they had much less information. So investors are dealing with information overload, and they are really taking a lot of emotional decisions and probably picking up a lot of bad advice through YouTube and other mediums. But for the rest of us that are rational value investors and that are able to apply the rational teachings of the Graham and Doddswell school, this is a good opportunity to be able to make money in the stock market in the long term. And a very small example of that is the rationality regarding Meta in the fall of 2022, which I've talked about a lot on this channel, but it just keeps coming back to my mind because Meta is one of the most followed companies and one of the most known companies in the world. Still, investors were acting like it was going out of business when the stock went below 90, and it just breached the $500 barrier. So it's quite nice to get a 5-bagger there in a company that is as large and as well known as Meta. And Warren keeps on giving us warnings about Wall Street, where he talks about Wall Street would like to see its customers make money, but they are all about the activity. And as long as there's activity, they can extract fees, and whatever foolishness can be marketed will be vigorously marketed, not by everyone, but always by someone. So we have to be on the lookout for charlatans. And if we think CNBC or some other Wall Street outlet can be trusted in recommending stocks, well, we probably shouldn't be picking individual stocks then. Next up, Warren touches a little bit on the long-term holdings they have in American Express and Coke, where the share of American Express earnings in 2023 considerably exceeded the $1.3 billion cost of their purchase, which is pretty amazing. And Warren also talks a little bit about stock repurchases, which should be price dependent, of course, and what is sensible at a discount to business value becomes stupid if done at a premium, which a lot of companies do. They just put the share buybacks on autopilot, a lot of the times because they are trying to offset the dilution from the stock-based compensation. Then he reminds us again about the importance of patience, where the lessons from Coke and Amex are: when you find a truly wonderful business, stick with it, patience pays, and one wonderful business can offset the many mediocre decisions that are inevitable. So here we can see the breakdown of the earnings for the company in 2023, and if all managers of the large companies that we follow in the market would break down their earnings so simply for investors, we would have a much better stock market, in my opinion. So we can see here that the insurance underwriting made a profit of $5.4 billion, which is quite good, especially seeing that Berkshire has a lot of long-tail insurance underwriting, which is really hard to underwrite since most of the surprises come years after, or maybe decades after you've written the insurance policy. And the investment income in insurance was $9.5 billion, railroad was $5 billion, utilities and energy $2.3 billion, and other businesses and miscellaneous items $14.9 billion, making the operating earnings $37 billion compared to $30 billion in 2022. So if we were to evaluate Berkshire based on the operating earnings, they have a market cap of about $880 billion. So we would be paying about 24 times operating earnings, but that does not include the massive stock portfolio that the company holds, which is very valuable. Now Warren also mentions BNSF and the Berkshire Hathaway energy businesses, which don't seem to be doing that well, and he talks about the outlays in excess of the gap depreciation since they purchased the company 14 years ago, have totaled 22 billion, or more than 1.2 billion annually. So that gap means that the dividends paid to Berkshire will regularly fall considerably short of the reported earnings unless they plan on increasing the debt of the company, which is something they're not planning on. So it does appear that BNSF is not as good a company as maybe once thought, seeing that it is one of the pillars of Berkshire. And we can see that last year BNSF earnings declined more than Warren expected as revenues fell, and the profit margins have been slipping compared to the 5 other major North American railroads. And the second and even more disappointing earnings were at Berkshire Hathaway Energy, where the regulatory climate in a few states raised the specter of zero profitability or even bankruptcy. So we can see that the operating environment for BHE is getting worse. So that does mean that Berkshire will not be able to get a decent return on their money in the coming years unless something changes. And Warren talks about here that he did not anticipate or even consider the adverse development in regulatory returns, and along with Berkshire's 2 partners at BHE, he made a costly mistake in doing so. So to conclude this video, I just want to point out this table at the back of the letter, which compares Berkshire performance to the S&P 500 since Warren took over in 1965. And we can see the compounded annual gain is 19.8% for Berkshire compared to the S&P 500 with dividends included, where they made a return of 10% per year. But the difference in percentage is very staggering, where you can see the overall gain is 4,384,748% versus only 31,223%. Now, getting a 10% return on your money since 1965 is pretty amazing, and you would have ended up very wealthy. But if you can imagine picking individual stocks and outperforming the market, not as well as Warren did by 9% each year, but just by 2 or 3%, you would end up very wealthy and in a much better situation given the compounding effect of 60 years. I won't be making this video any longer. I want to ask you to like and subscribe to the channel if you haven't already. Thanks for watching, and I will catch you on the next one.